A business can be profitable on paper, but broke by month end. Most businesses that fail don't fail because they are not making money. They fail because they ran out of cash. Now, cash flow isn't a finance topic. It's the oxygen the business breathes. And if you've been in a business that makes profits but is unable to pay salaries at the end of the month, you know exactly what I mean. Okay, so let's unpack this. Profit is an accounting concept. It reflects the revenue that is earned and matches it against the costs that are incurred. Profit is a story about performance. It's a story in the language of accruals, and it's extremely, extremely useful. And at no point in this episode am I alluding to the fact that profitability is not important. I want to just highlight the fact that cash is as important or even more important, because ultimately the profitability of a business proves or disproves if the business model works. Cash, on the other hand, is different in that it's a physical reality. The cash balance in your bank account tells you how much cash you have in your bank account right here, right now. It tells you the story of whether you can pay salaries at the end of the month, or put more simply, if you can keep the lights on tomorrow. Now, as much as profit and cash are related, they are clearly not the same. And I think that's the one key challenge that probably more non-finance leaders and finance leaders are, get caught out with. As an example, you could be profitable in one quarter and the bank balance could reduce, or conversely, have a loss-making quarter at the same time, have an increased bank balance. At no point am I saying one is better than the other. They both need to be looked at in combination, but the story of profitability is not the only story you need to look at. The cash flow statement is also quite an important topic or concept to look at. The interesting analogy we could use is there could be people in a boardroom celebrating a fantastic profit and loss statement for the last year. And at the same time, in the corner of the building, the treasury team could be sitting in the office stressing about the fact that the cash balance at that point in time is less than the expenses they need to pay quite soon. I think the confusion comes along in that the profit and loss statement is seen quite regularly, internally, often on a monthly basis or sometimes more than that, quarterly reported to the board and discussed at length. And further to that, we look at the profit and loss statement at the end of the year to determine bonuses, incentives, any performance metrics are reflected within the profit and loss statement. And unfortunately, the cash flow statement does live in the shadows. Apart from a few people who do look at the cash flow statement, almost no one else does. Or very few people look at it with the same amount of rigor and detail as they would with the income statement or balance sheet. And that's the real problem. The cash flow statement tells you whether a business can survive or not. And I think we need to spend more time on that. Now, there's the same pattern that comes through over and over. And if I can use a very simple example, there's a growing business that wins a contract. Everyone celebrates. The revenue is earned and the profit and loss statement reflects that, correctly so. So the income statement looks fantastic. We then deliver the product or deliver the service, and then we wait. We wait for the customer to pay us. 30 days have passed. 60 days have passed. 90 days, even 120 days may have passed, and we're still waiting for the cash for the product or service that we have delivered. While all along, we still need to pay our own suppliers, need to pay salaries, need to pay rent, need to pay taxes. Now, the profit is real on the books, and the profit is a good measure of the success of that business deal. But the cash flow statement shows that we haven't collected the cash to run our business. And unfortunately, you can't pay salaries with an invoice or a commitment from a customer. And thinking about this issue could be called a growth trap, because the faster you grow, the more working capital you need to survive. And just as reference, working capital is your debtors book plus your trading stock minus your creditors. And in a growing business, this working capital requirement could balloon or escalate very, very, very quickly. Every new customer, every new project, every new stock order very quickly sucks cash out of the business before it puts the cash back into the business. Now, I'm not saying we don't need to grow or we shouldn't grow. I'm just saying that with a growing business, the working capital requirement does increase very quickly. Now, there's lots of case studies that can unpack this in a lot more detail, and we're not going to do that now. But just as a very simplistic example, growing revenue, growing margins, growing profits. We've seen it before, sometimes leading to a company growing themselves into insolvency. Because the key part we need to remember is that profitability is not the same as liquidity. The two are totally different animals. And unfortunately, in the business world, the one is celebrated a lot more than the other. Now, the solution is not to grow. We need to grow our businesses in order to become sustainable. But the solution is as simple as it sounds, a lot more difficult in practice. Understand the cash timing or the timing of the cash flows and manage it a lot better. Now, how do we unpack this cash flow conundrum? And that comes ultimately down to cash flow discipline. And cash flow discipline can be explained in many ways. And I thought of looking at three distinct or important parts of the cash flow discipline. The first being watch your cash on a weekly basis. And not looking at it on a monthly basis when you get your bank statement, not looking at it on a quarterly basis when quarterly accounts are due, but watching the cash on a weekly basis is the first part. And more than that, creating what we call a rolling 13-week cash flow forecast. And that is a lot to unpack. So let's try and unpack it in pieces. A rolling cash flow forecast is updated on a continuous basis. And in this instance, a 13-week cash flow forecast would be updated at the end of every week, adding one more week on to that forecast. And 13 weeks is basically 3 months. Because ultimately, if you can't see your cash status or your cash flow 3 months ahead, you're actually flying blind. So the first part about good cash flow discipline is to create a 13-week cash flow forecast. The second part to good cash flow discipline is to manage the three cash flow levers deliberately. And those cash flow levers are number one, your accounts receivable or your debtors book. Number two, the accounts payable or the creditors book. And number three, inventory or trading stock. And all of these are very simple in theory, but a lot more complicated or difficult to implement in practice. So let's just bear that in mind. So the first part, when we look at the accounts receivable, it's just to get paid faster. And there's lots of mechanisms in place to get your customers to pay you faster, whether it be offering discounts on early payments, which in essence is cheaper than waiting for the cash months on end to hit your bank account. Also, constantly reminding the customers for payment. Sometimes a person just needs a courtesy email, phone call, visit to remind them that they need to pay. And then finally, there are definitely mechanisms that you could put in place to ensure that if customers pay you late, you implement those mechanisms, whether it be a penalty or an interest or so on and so forth. The second cash lever is the payables, where I would say pay the suppliers when they are due, not earlier. We often want to pay people, or we sometimes would be inclined to pay a little bit earlier than the due date, but rather the same way in which the debtors pay when it's due, you should pay your creditors also when it's due, because we need to ensure that we are preserving our cash as far as possible. And then finally, when it comes to trading stock or inventory, try not to purchase more stock than is needed, because every piece of stock or every unit of stock on the shelf that is not being sold quickly enough is actually doing no good work while it's sitting idle on the shelf. The third part of good cash flow discipline is to distinguish between our operating cash and our financing cash. Now, just as basic principles, operating cash is what do we generate from doing what we do? And financing cash is getting money from either shareholders or lenders, so loans or capital. And it's very important to distinguish and ring fence and separate the two, just because long game businesses build models that generate positive operating cash flows over and over and over, and compare that to short game businesses that survive on constant injections of the financing cash. And we've seen that examples many times before, where constantly increasing the overdraft facility or getting more money from the bank or asking for more capital just in order to allow us to survive in the short term. The one model is sustainable, where we're generating continuous operating cash, and the other model, where we refinancing or asking shareholders for more funding, is basically just a countdown to to failure at some point. And to round up this part about the good cash flow discipline, the best businesses treat cash like oxygen. We don't hold our breath. We breathe it consistently. And how do we create sufficient cash to breathe it consistently? We generate reserves over time. And reserves is something where some businesses like to keep it as low as possible so that any money that's in the business can be deployed in ways to generate more cash. But there is a level of reserves that we need to keep in the business, not because we're pessimistic, but so that we can play that long game. We can make long-term decisions while others are making short-term decisions. So in closing, if you only watch one number in your business, watch the cash or the cash flow. Profit is an opinion. Cash is truth and fact. And businesses that know the difference between the two are the ones that are playing the long game properly.